presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak YouTube update for January the 4th, 2023. Happy New Year, everyone. We've got a new year. It was a wild year for 2022. I think 2023 is going to be better. Let's talk about why I think it's going to be better. Let's look at the year in review, do some technical analysis, what I think of the market, and the outlook for the week ahead. Let's start with the year in review. Well, it seems like the Fed, the old saying goes, you don't want to fight the Fed, and it seems like we're coming to the end of the Fed tightening cycle. We'll have to wait and see. The anticipation is 25 basis points February the 1st, another 25 in March, and that's it. And the Fed has to get the market, but as soon as they hint that they're coming to the end of the interest rate hikes, that's where I think the market says, okay. If it looks around, we'll see how slow the economy is. If the economy is slowed dramatically, it's going off the cliff, then I think the stock market is going to have a tough time going up. But if the unemployment stays up like it has and consumers continue to spend money, then I think we are going to have a mild recession, and the market looks ahead for the end of second half of 2023 of this year and the first part of next year and says, hey, it's not going to be as bad as everybody thought. The Fed is done raising interest rates. They've slowed down the economy, but a lot will depend on how the inflation numbers come out going forward. You can see the change in valuations that we've seen in forward PE ratios in most of the recessions in the past. You can see that in the 2000 tech bubble, we saw a compression of about 29%, where we saw change in valuations. There we saw the PE ratio come down. The worst was 2008-9, where we saw it come down. Then again, 2010, we already down 26% in valuations from the highs. So we've already adjusted to the market so far. Now, if inflation continues to go and the Fed says, look, we have to continue to raise interest rates more than the 5% Fed fund rate that we indicated at the last meeting in December, then I think the market will have to adjust again downwards if that happens. But I think we're getting to the end of it. We're going to get the beige book or the Fed's notes from the last meeting this week, and then we get unemployment data on Friday. That'll give us an idea. Unemployment has to start going up at least a little bit to absorb all the job openings there. We have to have the JOLTS number, as it's called, the job openings out there. If they start coming down, that would be a good sign. That means the labor market is coming back in balance. And as I said, all last year, until unemployment starts to go up, the consumer will continue to spend. You can see that the consumer has proved very resilient last year in 2022. You can see that this was GDP growth in blue, and you can see this is consumer personal consumption. You can see that in 21, people are making up for being locked up because of COVID, but you can see that end of 21, we saw GDP going up a lot more than, but you can see first quarter of this year, last year or 2022, GDP was negative. Everybody said, here comes a recession. It wasn't. We had 2 negative quarters, and that is a typical sign of a recession, but there was no recession. There was a recession. It was on Wall Street, and it was in the real estate market, not on Main Street, and that's what we have seen. You can see the personal consumption continues to outpace GDP, and you can see as long as we're seeing consumer consumption hold up, that means consumer spending, that's 2/3 of the U.S. economy. As we talked about last year, we thought the inflation would peak somewhere in June and July. That's when we were seeing, oh my God, 40-year highs for inflation, it is killing everybody. Well, it has rolled over now. Car prices are coming down. A lot of the prices are coming down. One of the largest components is personal shelter or rents and mortgages. We are seeing rents starting to stabilize, and I think they will start coming down. You can see the CPI has already rolled over. You can see the core CPI peaked out, and it has also rolled over to the downside. So we're seeing it coming down, the CPI and the core numbers, when you start comparing it to last year, are basically flat. So we can see the core coming down to somewhere around 2.5% fairly quickly. And if it comes down to 2.5%, the target for the Fed is for core rates to be around 2. Job openings, this is the big difference right here. The gap is still very wide between the number of unemployed people and the number of job openings. This is still, we need to get this shrinking where we see the number of unemployed people going up, number of job openings coming down, and that would be a good sign that the economy is slowing. It's hard to say with people getting unemployed, but that's what the Fed is looking for and hoping for. Housing market in better shape than it was in 2008. You heard me talk about it, how people have equity, so they're not going to be forced to sell their homes or just turn over the keys. Nobody wants to turn over. They've got $30,000, $40,000, $50,000 in equity in their home. They're not going to give that away to the bank. They're going to hold on to it. And that's the housing bubble we saw, where we saw in the aftermath, we saw equity was less than the debt. And this is where people are turning in the keys. But right now, you can see equity compared to debt. There's a huge difference between the two of them. And that is why I think we're not going to see 2008, 2009 crash in the real estate market, but we do see a slowdown. Housing, people are still trying to get the price that they saw for the home last year. It's not happening. But the people who want to buy the homes are saying, look, I can't pay this 6% mortgage. You have to bring the price down. So we have a disconnect between the sellers and the buyers. They will come together when the sellers realize they have to bring down prices. The buyers realize that, hey, mortgages are going to be at 6% and you have to buy the 5-6% mortgage. You're not going to get the 3% mortgage anymore. When that reality sets in to the buyers and sellers, then we are going to see some equilibrium. But it takes time. Real estate moves very slowly because everybody doesn't get their real estate price every day as you do in the stock market. Don't forget, if you want to listen to the daily edition of Market Wrap, you can just go to the Apple Store and type in the entire word, Market Wrap with Mo Ansari. As long as you type in Market Wrap with Mo Ansari, you'll get the free app. Download it. You'll get the daily edition every day, 1 hour, great guests, every day a daily update. Let's take a look at the technicals. We saw the interest rates peak out right here, close to 4.35, close to 4.4. Then we came all the way down, hitting a low right here at about 3.4. Now we're back up to about 3.793 or 3.8 today. The 50-day moving average is 3.8 today on the yield. So we're right there. We could go a little bit higher, back up towards here, but I think we've set the range somewhere around here as the top and the bottom on interest rates. As long as we stay below 4.5, I think we're okay in the 10-year. We'll bounce around here as the Fed talks about raising interest rates. S&P got above the 200-day for a couple of days here, a couple of days here, failed. Now this blue line is the 50-day at 3,900. The red line is the 20-day moving average at 38.74. We hit 38.78 today, got up to the 50-day, but then failed and came all the way back down. We closed at 38.24 or so today. So stuck here. We break to the downside. We've got a little bit more support here, which is 3,700. As you can see, we break below 3,700, then there's really nothing until 35. I think we just bounce around between 37 and 41, back and forth, up and down, until we'll get some clarity from the Fed that they're done raising rates. So first couple of months of this year are going to be choppy until we get some clarity. Here we've got resistance. These are weekly charts. Each one of these lines, vertical lines that you see right here, these vertical lines, red and green lines, are 1 week of trading instead of 1 day. And you can see resistance is 4202, then 4,000, and 38.59, close at 24 today. So we're right there. That's the 20-week moving average. This is the 50-week moving average, this blue line right here. And we need to get above those to really clear the path. We have not done so yet. NASDAQ is the biggest problem. Can't keep to get out of its own way. Here you can see that it got not even close to the 200-day moving average. We've fallen off from there. We're at 10,000 and change. We need to get above the 50-day, which is 10,900, 10,675 is, and we are 10,088 or so is the resistance support right here. That was the low that we made right here in October. We break below, and we're only 300 points off of that. If we break below, I think we have a chance of going down to the 10,000 mark in the NASDAQ before we see the turnaround. On the weekly charts, as long as these dots are above the market and these vertical lines are the market, we're in a bear market. When the market is above the dots, we're in a bull market. You can see it started right here in April of 2020, stayed up until about the beginning of this year, stayed down. We went up for a few weeks right here, and then we turned back down right here, which is somewhere at the end of July. And since then, we haven't seen the NASDAQ get positive at all. We need to get above 11,622. That's where the dot is. If we hit those dots and get above that, that would be positive. But that's still nearly 1,000 points away from where we are right now. Looking at the crude oil market, everybody is so excited about China opening. I said, wait a minute. If China reopens, they're going to allow COVID. That'll slow down the economy. That's what they're going through now. And oil today dropped off dramatically, $3 and change, and closed 76 and change. Everybody's saying that that's going to be a problem. I think so too. We're going to see this wave of COVID infections, and then they'll subside once they get to herd immunity, but that takes 6 months or so. Millions of people, they're saying about 1 million to 1.5 million could die in China, but they've got 1.4 billion people. So it's unfortunate. They had 3 years to prepare for this, for the reopening. They just thought that if they locked everybody down, they wouldn't get COVID. That's not how the way pandemics work. It doesn't care. It will linger until they see the first opening, then it attacks. So now they've completely reopened everything. Everybody can go everywhere. And so that's going to increase the infections. I think it'll take some time for China also to get through the COVID and get to the other side before they get the total reopening. And that's why I think oil is going to remain on the defensive, just sort of in a range somewhere between 82, 81 and a half, and the $70. Because at the bottom at 70, the administration said they're going to buy crude. Gold is the one positive thing. We closed at the highest level since June of last year in gold. Silver, the highest level since April of last year. Platinum, the highest level since March of last year. Precious metals are telling us something, that the rates might have peaked, because when rates go up, gold goes down, interest rates. And if the interest rates have peaked, as far as the market is concerned, the Fed might do 2 more increases, but that means the gold market can clear, and that's why the gold market is looking strong. We're above the 200-day moving average, and that is the only thing that is giving me some indication that we might be closer to a bottom in the stock market, more volatility of a month or so, and then we take off. Again, if you want to get my weekly newsletter, just go and sign up for Mo's Market Minute at Compak.com. Looking at the week ahead, again, we have to look at the JOLTS number, that is the job openings number coming out later this week, the Fed Beige Book coming out later on this week, and then the unemployment number on Friday. That's going to be a biggie. If we can get this unemployment going up a little bit, that means the Fed raising the rates, the brakes that have applied to the economy are starting to take hold. Those are my views. Those are my thoughts. Again, if you need help with your portfolios, feel free to give us a call at Compak or just go to our website, compak.com. I'm Mo Ansari. Thanks for tuning in. I will be back with you with the next update, and you will get notified if you are subscribed to this YouTube channel.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.